proved their worth in an inflationary time, that this would have to do with resources. My postulation, Mike, is that if we don't, and I'm not saying we won't, if we don't have a really, truly severe worldwide synchronized global recession, that a broad spread shortage in commodities will develop sooner rather than later. If we do have a recession, it'll be postponed, not eliminated. If that's true, that means that extractive industry prices across the board will go higher. And that's very interesting because the equity prices for commodity producers, oil and gas producers, base metals producers, and in particular gold and silver producers, suggests that those commodities are headed lower in price. If that conjecture is incorrect, if that widely held precept is wrong, there are superb opportunities in the resource space. The disparity between commodity prices and the resultant free cash flow to commodity producers and the equity prices, the market capitalizations commanded by those producers, is as broad as I have seen it in a 50-year career.
In a recent discussion, investment experts Rick Rule and Mike Maloney delved into the evolving investment landscape, focusing on precious metals like gold and the oil and gas sector. Less than 0.5% of U.S. savings and investment assets are currently in precious metals, though historical data suggests their market share should be around 2%. Rule predicts a significant rise in demand for precious metals over the next 5 years, potentially quadrupling their market share. Economic uncertainties such as inflation and fiscal deficits are pushing investors toward assets like gold, known for their stability during turbulent times. The oil and gas industry, particularly outside the U.S., offers promising investment opportunities. Companies in this sector are currently undervalued relative to potential returns, making them appealing for those seeking inflation hedges. Understanding economic indicators like interest rates and fiscal policies is crucial for investment strategies. Maloney and Rule emphasize the importance of factoring in taxes and the true cost of living. For young investors, grasping the potential of precious metals and energy resources can shape long-term investment strategies. Rule advocates for a contrarian approach, suggesting that assets like gold and silver may provide stability and growth amid market volatility. In conclusion, Rick Rule highlights the growing interest in precious metals and the oil and gas sector, driven by economic uncertainties. Their insights offer valuable guidance for investors navigating financial markets, including young individuals securing their financial futures. Now, we'll show you more clips or Rick Rule on his latest interview, but first, LKE subscribe and turn on notifications and let us know in the comment section down below your opinion on the video. Also, check our description to get some massive sign-up bonuses in the most sought-after crypto exchanges if you want to further diversify your commodities portfolio while also supporting the channel. Link in pinned comment. And now let's get into the video.
But the cheapest sector, I would suspect, is precious metals. And I know in the comment section after this interview goes up, people will say, that old man's crazy. Gold hasn't moved for X amount of time. Why on earth would he be talking about gold? That's precisely why I'm talking about gold, because it hasn't moved. Except, Mike, it has. When people ask me when gold is going to move, I say I made substantial additions to my gold holdings in 1998. And it is true for 2 years that the gold price didn't move except for down. But since 1998, the gold price has moved from $256 an ounce to $2,000 an ounce, which is to say an 8 or 8.5% compounded gain for 24 years. When's gold going to move? Well, over the last 2 decades. My suspicion is that the moves become more pronounced in the next 5 years than they have been in the last 20 years. And if that's true, then the gold companies, from the highest quality, the royalty and streaming companies, through the senior producers, through the intermediate producers, through the single asset producers, through the high quality developers, are in historical terms insanely cheap. And I'm not suggesting that your listeners put 100% of their net worth in expensive penny dreadfuls. What I'm suggesting is that gold is so deeply out of favor that the market share of precious metals in the United States, the largest savings and investment market in the world, is less than 0.5%, which is to say less than 0.5% of savings and investment assets in the United States are denominated in precious metals. The 40-year mean market share of precious metals is 2%. If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today.
Yeah.
By the way, it's estimated by JP Morgan Chase, and it's only estimated because they didn't have data going back that far, that the market share of precious metals and precious metals related assets in 1981 exceeded 6% versus 0.5% today. That's speculative. You don't need to say that demand is going to increase 12-fold. Increasing fourfold is certainly enough to reward investors and speculators. I find most investors in the world can't spell gold, despite the fact that it's a 4-letter word. Your listeners are probably more sophisticated with regards to that. But the truth is that I think that the disfavor that gold and silver find themselves in is a rear view mirror disfavor. It doesn't take into account debt and deficits. It doesn't take into account the necessity to inflate, and it doesn't take into account the historic cheapness of these assets and their reduced market share relative to other asset classes.
Gold and silver prices relinquished mild overnight gains and are facing modest selling pressure in early U.S. trading on Friday, spurred by a hotter than expected U.S. inflation report. The latest U.S. Producer Price Index report for January revealed a 0.3% month-on-month increase, with the core PPI, excluding food and energy, up 0.5%, surpassing expectations. This was partially offset by a U.S. housing starts report for January, showing a 14.8% decline, contrary to expectations. Mixed performance was observed in Asian and European stock markets overnight, with U.S. stock index futures anticipated to open on a mixed note. Additionally, the Wall Street Journal highlighted a concerning trend where the U.S. government is projected to spend more on interest payments than defense. In the broader markets, the U.S. dollar index surged after the PPI report, while NYMEX crude oil prices weakening at around $77.75 a barrel. The yield on the 10-year U.S. Treasury note rose to 4.322% post the PPE release. Notable U.S. economic data slated for release includes new residential construction and the University of Michigan Consumer Survey. Hit the like button to let us know you're enjoying the video. Let's get back into the best clips of the Rules interview.
The oil price has been coming down. The gas price has been coming down. It is true that if there is a resolution of the conflict in Ukraine between Russia and the Ukraine, I'll leave that to your viewers to determine the probability of, that there is more downside in the oil and gas price. There's more downside too if there was a revisit of COVID, which stopped air travel again. But in the absence of that, the oil and gas industry, outside the United States in particular, is underinvesting $1 billion a day in sustaining capital investments. What this means is that the current levels of production will not be able to be maintained if the industry doesn't pick up its capital spending. It isn't deferring capital expenditures because it doesn't have the money. These companies are making a fortune at these prices. They are curtailing capital expenditure because the political class has told them that they're going to put them out of business in 2030. When President Biden asked the oil companies to invest more in oil and gas and says at the other side of his mouth that he's going to have them out of business in 2030, this sort of thing doesn't work. If you believe, as I do, that peak oil demand occurs in 2065 rather than 2030, the oil companies are cheap. The rub is, do they get cheaper? And that really revolves around, do you think that the Russia-Ukraine conflict ends sometime soon? And do you believe that there's going to be a global recession? Even if you believe there's going to be a global recession, what a global recession will do is push out the peak punch point, the peak shortage, from something like 4 and 5 years from now to 7 years from now or 8 years from now. So in terms of inflation-adjusted returns, the arithmetic suggests that the oil and gas companies are cheap, and they have proven to be effective inflation hedge.
What do you think of today's show? Do you agree with Rule and his take on the bullish long-term expectations for gold? Are you accumulating more gold or silver? Post in the comments section if you're bullish or bearish on gold, and what's your conservative price target for 2024? Thanks for watching the video to the end. If you liked this video, you'll love this next one. I see you on the other side.